Grab a seat, feeling great. Who's ready to learn some more? Raise your hand, make some noise. Okay, so let's get down to business. We have a lot to go through. This session, you will learn the 3 key areas that you can create wealth in and how to accelerate your wealth, how to become wealthier faster than most. We will go through 8 ways to get started to creating wealth, so we cater for everyone, and how to accelerate your wealth. We then will go into the share market. We'll look at Warren Buffett's strategies, what made him so successful, and we'll model some of his strategies in the share market. Then we'll go into some cash flow producing strategies, such as how to rent shares for instant cash flow. Is that of interest to anyone out there? Yeah. So we're going to look at those strategies. We'll look at how to insure our shares. And also you're going to hear from Andrew Baxter after that, and he's going to go into some more depth as well. You're also going to leave here today in this session actually making a trade. It'll be a paper trade, but you'll actually be able to make a trade and check in over the next month or so and see how much money you would have made. Because when we start any strategy, it's always a good idea to test the waters first so you get a better understanding of that. Okay, so jot this down. The word that we're going to look at, which I guess is the whole foundation of creating your wealth, the blueprint, the foundation, like having the plans for building a building, you have your blueprint. This is basically the blueprint. Jot this word down. The word is synergy. What is the word? Synergy. So 1 plus 1 equals what? 1 plus 1 equals more than 2. Is the concept that we're after. So what synergy does, it gives you an exponential return. So one of the reasons I was able to accelerate my results and become a millionaire in my 20s was because I was using a combination of strategies. So by doing that, I was able to combine strategies and get a result quicker than if you just use one strategy. So there's only 3 major areas you can create wealth in. And all investments predominantly fit into these 3 key areas. The first area where we all start, generally, is we start with a job. Is that true? We leave school, we get a job. That's our first goal, and we have some money. It's our job or career. And some of us will go into business at some point. So we'll have either a job or business generating income. And that can build up wealth. Out of that, though, this is the most predominant way in Australia and New Zealand that wealth has been created. People with their job or business income, they will save some of that and they'll put their surplus down as a deposit on what? On property, on real estate. Now, just doing that is the most fundamental way that most people create wealth in Australia. By building up the surplus income and putting into property. So just that creates a synergistic effect. Because here's the difference. People think to become wealthy, you have to work hard. Well, the reality, you'll actually work less than people that don't become wealthy in the long run. Let's say we have person A, person B. Person A works exactly where you work. They earn the same income as you. They sit right next to you at work. And person A decides to spend their money and not save for a deposit on some real estate. Well, you go and get yourself educated, you get motivated, you face your fears, you do your research on the property market, and you decide that you're going to save up and get a deposit, and you buy a house or you buy an investment property. Okay? You're doing the same job, you're earning the same income. The reality is, over a 10-year period, in 10 years' time, if you'll put a deposit down on, say, 2 properties, and Conrad would have talked about this last night, an example in real estate, in 10 years' time, you're working no harder than the person next to you at work, earning the same income. The difference is you will have sizable assets that have grown in value over that 10-year period where if you're not already a millionaire, will be well on the way to becoming a millionaire. Does that make sense? You haven't worked any harder than person A. All you've done is leveraged your time. So while you're working, you had property at night while you were sleeping, rising in value over a period of time, making you wealthy. That's the most common way people become wealthy. And if you look, let me ask you this question. Who wishes they had bought more real estate in Australia 10, 15, 20 years ago? Okay, that's called hindsight. Okay, to become a millionaire, you have to have what? You have to have foresight. Now, what I find is interesting about real estate is there's some people in this country that don't believe in real estate. There's some people in this country that don't believe in people like myself either. And these cynics or critics of the real estate game I've told people, they made these ridiculous quotes. They said that the Australian real estate is going to crash 40%. This is like 18 months ago, at the start of the credit crisis or even before it. Australian real estate is doomed, it's going to crash 40%, don't touch it. Actually, there was one professor in Sydney, a Professor Stephen Keen, I don't know if anyone's heard of him before, okay? And he categorically got a lot of PR over the fact that he said Australian real estate is going to crash 40%. So much, I'm so certain of this that I'm going to sell my own properties. And he sold his apartment in Sydney because he was afraid it was going to crash 40%. Now, nothing against professors, but professors don't get paid that much. You realise that? To be a university on a professor's wage, they don't get paid that much. Is he a real estate expert, yes or no? No, theory is different to real-life reality. There's other people out there, I won't mention their names, that have agendas to talk people out of property for their own self-interest. Now, I don't care whether you go into property or not. I'm an educator. I'm unbiased. I've made money out of business, out of real estate, and out of the share market. And I'm an educator and I don't sell investments. So what you do, I don't really care. Does that make sense? As far as the end result is this. People argue, is property or shares? What's the best? Property or shares? And it's like, do you have a Holden or a Ford? You know, it's like this Australian debate. Should I go property or shares? I don't really care. You shouldn't care either. What you should care about is what? What do you want? A result. So if property can give you a result, use it. If shares can get you the result, use it. If both together can get you an exponential result through synergy, then that would be even smarter as well. And that's what we're going to lead into. Making sense? So we don't necessarily want to bias because we don't care. What we want is whatever vehicle will get us the end result. The end result is lifestyle, to have time and money. Okay? So my views on the real estate market have been very different to some of the critics. Some of the critics, and this is where they go wrong. And I've done a lot of articles on this. I spoke on radio a lot about this. And I've been proven right. Okay, I went out and did an article some time ago and said the Australian property market it's more likely it will grow 20% than crash 40% at the beginning of the credit crisis. And the critics are going, as if, whatever. And I said, well, let's just wait and see, shall we? Let's see what happens. And what has now happened? Australian real estate did not crash 40%. In some cases, in some of the worst suburbs, it might have dropped back 15, 20%. Many suburbs only dropped 5, 6%. Australian real estate, in many cases, in the last 12 months, has actually grown. In some cases, grown substantially. Most across the country has recovered from any drop through the worst credit crisis since the Great Depression. Think about this. People want to pick on property, but think about this. What more could you ask of an investment? Through the worst credit crisis, biggest crash since the Great Depression, if you owned real estate in Australia, then it's now risen back above what it dropped through the worst crash since the Great Depression. Could you ask more of an investment than that? Yes or no? Who would have loved their super fund to have performed that well? Okay? Who would have loved their shares to have performed that well? Okay, so I'm not saying I'm biased towards property, but here's my suggestion. It's up to you, but anyone long term really should have some Australian residential real estate in your portfolio as a long-term investment. I can't see how you could say, I'm just never going to touch property in Australia. I think that would be crazy. I think it's a longer-term investment vehicle. Long-term, people say, if you're only going to do one thing out of, say, property and shares, I'll take some questions in a moment, out of property and shares, you say, if you're only going to do one, I would probably suggest do property. Because long-term, 10, 20 years' time, you'll be better off than if you just did shares. That is just my opinion. Okay? It's up to you what you do. Who's following what I'm saying here? Okay? And statistically, that would probably be right. Because the great thing about real estate is once you set it up, you've done the hard work is getting the loan. That's the hardest work. The hardest thing about property is getting finance and making sure you buy at a good price. Your profit is made when you buy. You pretty much remember that. See, here's the other thing with property. You could be a complete moron and make money in real estate. Do you know that? You can do that. Let's say we put a map of each capital city in Australia up on the wall and we knew nothing. Let's say we were morons and we just knew nothing. But we knew how to throw a dart. And this is our investment strategy. We get the data out, put a map of all the suburbs on each capital city up on the wall, and we even blindfold ourselves and just throw the dart. Wherever the dart lands on whatever suburb and whichever capital city in Australia lands on, we go and buy a property. That's our investment strategy. And we come back 10 years later, 15 years later, 20 years later and check on the value of that home, that investment property we bought. Who here is fairly confident that it's risen in value significantly? Who's fairly confident of that? Okay? You'd be very confident. Now, no one knows the future, but you'd be fairly confident that why? Based on history is one reason, but two, also based on fundamentals. So the reason why I was so confident that Australian real estate would survive the credit crash, not crash 40% and actually grow, and now I predict it to boom quite well leading up to 2050, is based on fundamentals. The people that were criticising or critics of it, their fundamentals were wrong. What they were saying is, well, the US has crashed and the UK has crashed, therefore Australia will crash real estate. But they got it wrong. Why? Well, a few things. The US over-leveraged and had subprime lending. Is it true? Over-leveraged to the hilt. It was very obvious what was going to happen in the US if anyone was following the market. I had friends that were investing over there. Actually, one of my good friends from the US, he's worth about $400 million. He bought over 1,000 investment properties in the US. But it was interesting when I was about just before, probably 3 or 4 years ago, he said, Jamie, I'm getting out. I'm selling all my properties. Very smart guy. Sold most of his apartments, 1,000 apartments, and moved into a different investment strategy. But very clever. Did you notice that? He made a fortune through the rise, smart enough to get out beforehand. And now he's back in buying again. He's having a field day. Meant to be going on a holiday to French Riviera. He says, sorry, mate, I can't meet you there. I'm just bought another 20 properties, and I've got a goal to buy another 100, and he's bought about 100 properties in the last 3 or 4 months. Because he's back in the game. But how smart was it? He got out, everything crashed, is in. So the US had different fundamentals around real estate. So what I'm trying to teach you is that you don't have to be a guru. You don't have to be a brilliant economist to figure it out. Probably best you're not an economist, actually. You don't. All you have to do is, this is what you have to have. Jot this down. All you have to have is common sense. It's really, the thing about what you say, you go away from this event and people ask you, what did you really learn? Well, you could probably say, really, I really just learnt stuff that's common sense. But they shouldn't call it common sense, should they? Because it's not very common, is it? It should be called uncommon sense. So the US property market crashed because of risky lending, subprime lending, loaning to people that don't have any money, can't afford to make the repayments, and it inflated the property market. So if we imagine we did this today in Australia, we said, okay, anyone in Australia can get a loan. Anyone. What would that do to the property market in the short term? It'd take off, wouldn't it? Because everyone would be going out buying property, pushing the demand of property, push the prices up in the short term. But then what happens if everyone can't start paying their loans? What happens? Foreclosures, properties go on the market for sale, no buyers. That's common sense is what's going to happen. And that's what happened in the US. Okay. Also, the difference in the US was this. The US has an oversupply of property. They were constructing too much, building more property than they needed. In Australia, did we take on risky subprime lending, yes or no? No, our banks were much more conservative. We had low doc loans, etc., and that did help the property market go, but still, that was managed, so the risky lending wasn't taking on. So we had a much more prudent banking system, probably one of the best banking systems in the world. The great thing about paying outrageous fees to banks is they make such great profits that they're safe. That's the only damn benefit. You know, Australia has a safe banking system because they've been ripping us off for that many years. They've got so many profits, they're safe. So at least there's some benefit in that, okay? So we had a better, safer banking system, and that's good. They were much more conservative. 2, did our construction industry build too many properties or not enough? Not enough. The amount of properties in Australia, they were producing 155,000 a year. It went backwards. They only produce 150,000 a year now. And they need, guess how many? At least 165,000 and growing a year. So they can't even keep up to what they used to build. They've gone backwards and the demand's gone up. That's different to the US, which has an oversupply. So we have a construction industry that is undersupplying property. And there's some short-term pressures there that's going to keep it that way for a while. And do we have declining population or increasing population? Increasing population. Thanks to our former Treasurer Peter Costello with the baby bonuses, we have the highest fertility rates we've had since back in when all the baby boomers were born. Okay, a lot of babies being born, but more so the population is growing from what? Migration. A lot of immigrants coming to Australia, and we have record immigration levels. And even in the credit crisis, I was saying, we better slow it down. It slowed down only briefly. It's actually booming again. Fertility's high, so we have record immigration. So much so that the government had to release figures a couple of months back, and basically had to revise Australia's forecasted population by 2050. It had to increase it by 7 million extra people. Instead of being estimated 28 million people by 2050, it's now estimated to be 35 million people. Now, if you know those facts and you factor that in, is that likely to cause a property crash or property increase? No guarantee, but it's likely to put more upward pressure for the next 40 years on Australian real estate. Not like Japan, where you can say, oh, Jamie, what about Japan? They had record high property prices in the 90s and it crashed. Yeah, but they also had an aging, very old population and a population in decline. So which also helped contribute to that, plus other economic problems. Now, the other thing you say, economically, Australia, not only do we have estimated high immigration levels and fertility levels, economically, is Australia very poorly positioned for the next 40 years to the rest of the world, or perhaps in one of the best positions of any Western economy? We're perhaps in the best position of any Western economy. So I did some articles on this in the recent months and basically said Australia's in a position to boom for the next 40 years. I'm fairly bullish on it. No guarantee, with some asterisks next to that, because there's some things that can go wrong. But Australia, you've got to understand this, and New Zealand, the only difference Australia and New Zealand is that Australia has things that we can dig out of the ground and sell to who? China. And New Zealand doesn't have that. New Zealand economy is not as strong, but still doing. It's now picked back up. Any Kiwis in the room? Who's a Kiwi? Okay. So most Kiwis are going to move to Australia anyhow. So let's not really talk about New Zealand. Okay. No offence to our Kiwi members, but here's what you've got to look at as you're an investor. Treat New Zealand as another state of Australia. Okay. Yeah, now, when I'm in New Zealand, I do explain it the other way. I say, in New Zealand, just treat Australia as the West Island. It's one investment market, okay? Same thing for shares. If you're a Kiwi, you're going to invest in the Australian share market or US, not the New Zealand share market predominantly. And property market, treat it just as another island of New Zealand or vice versa. It's one market, so let's just keep it generic. Because there's great opportunities in New Zealand as well. Where was I up to? Oh, economic performance. So Australia, fundamentally, is truly a lucky country. We've been labelled that in the past, but this credit crisis proved we're incredibly lucky, because what's lucky about us is that Western nations are in decline, largely led by the US and Europe. US in particular is in decline. Who's figured that out already? Okay. See, what happens, US peaked in the 1970s. When a country peaks economically, the only way it can maintain control is then through military. So they spend a large amount on military. You have a big military, you can maintain control for that much longer. But eventually, you can no longer afford that, and they will be in decline. So what is happening is the Eastern nations, the Asian nations, are rising and becoming more powerful, led by China and India in particular, but even other countries in Asia. And the Western nations have peaked some decades ago and are in decline, led by the US. Australia is very lucky. We're a Western nation. It's fully developed. A stable government, good banking system, highly intelligent people, charming, good-looking. Agree? Yep. And but what we have going for us is that we benefit from being a successful Western nation. As the others go into decline, we actually can go on the boom. Why? Because we're tied very closely to China. So we can ride off their back to a large degree because we've got a lot of commodities. So we're lucky for that. And then we've got a small population. So we've got a lot of wealth and divide amongst the population. So we can be on the cusp. So that puts us in a very strong position if we have smart leaders as a country. Now, that's a big if, isn't it? Okay. But if we have smart leadership, in other words, saying we have, and what I suggested was that as Australia, we had the position to be a major, significant economic player. For a small country, we always punch above our weight. In sport, etc., in the Olympics, we punch way above our weight. And economically, we now can do that if we're smart about what we do. Why? Because we're a fully developed nation with a very stable government, stable banking system, and we ride off the boom of Eastern economies so we can really lead and be a big part of that. Okay, so that's good news for us. Is that true? Very lucky you live in Australia that you can benefit from that. And we missed the credit crisis to a large degree. We had a small recession. It wasn't as bad as it was probably expected. And a lot of the fear was coming predominantly from the US. So what I'm going to suggest is that, and this is important as we go into the stock market, is Australia has to divorce itself economically from the US. It largely is divorce, but when we're a share trader, we tend to follow what the US market does, and then we mirror that. And that needs to change. We should not, the better way to predict what was going to happen through the credit crisis for Australia, we should have been better off watching the Chinese stock market more so than the US stock market. Does it make sense? What happened to the Chinese stock market in the last 12 months? It's gone crazy. Now, there's some asset bubbles occurring there, but the point is, that's more of our economic future, not the US. The US will cause a lot of nervousness as their stock market crashes again, etc. Australian investors will panic, and that will cause our market to go down based on jot this down, based on sentiment. What's known as sentiment, not on fundamentals. Because fundamentally, we shouldn't go down. Because our future is not like US's future. Their future is fairly bleak economically, unless they make dramatic changes, where ours is great, unless we stuff it up. Okay? Is this making sense to everyone? So just common sense. So you say, Jamie, what has this got to do with me becoming rich? Has everything, because as to become a successful investor, you need to understand basic fundamentals. If you understand that, you don't need to know much else. Or if you don't understand it, just get your dartboard out and throw it at a suburb in Australia, and if you invest in property long term, you will do okay. Okay? Now, the other reason property will grow over time is because incomes and salaries will grow over time, and there's inflation. Inflation can work for you. What's great about inflation is that if you borrow $300,000 today, the time you pay it back in 20 years, is that $300,000 the same $300,000, or it's worth a lot less? It's worth a lot less. $300,000 in 200 years, in 20 years, is not the same value because of inflation. It devalues. That's why banks hate inflation, because it costs them money. You borrow $300,000 today, which is $300,000, you pay it back over 20, 25 years, the money is actually working because it's less. So that's a good thing about property, is that even though there's inflation, you get the leveraged effect of that. If you put a 10% deposit down and you borrowed 90%, you've got a 10 times leverage effect above the inflation. So if inflation is growing at 3%, you've got a 10 times leverage of that, and that's working to your favour. Okay? Now, even though you might own a lot of properties in the future, money's not worth as much, it's still worth more than what if you didn't do anything. Making sense? So what I'm suggesting is that property is probably a good idea to have in your portfolio. That's what I'm suggesting, long term. Okay? And most people agree they wish they would have had more of it. And as a strategy, that can work quite well. So I'm bullish on the Australian real estate market because of those fundamentals. High immigration, high population growth, slow construction industry, not enough housing, and the state and federal governments really haven't got it sorted out as far as releasing enough land to really catch up. So the people that will suffer is that the cost of housing will just be expensive. It already is expensive in Australia. And the other comments, people say, well, Sydney property prices are so expensive, how can they ever go up? Now, they said that in the late 80s. And the last recession, now here's other information to know. Why I didn't believe property was going to crash 40% during the credit crisis, because I look back to the last recession. Did property crash in the last recession in Australia? It didn't. It actually rose. So knowing this stuff, it just gives you not a crystal ball, but it gives you insight into what's really going on, because if you read the papers, you're not always going to figure out what's going on. You have to read between the lines. There's agendas in the papers to push the share market ahead of properties, and there's other people that just want to spruik property. And they have their agenda as well. So you've got to sort all the sensationalism and all the half-truths and the mistruths and say what is really is. Because you want to base your plan on reality, not someone's distorted perception of reality. True? That way you have more accurate decisions. So you have to be better at judging those things. Or you just have to be in the game. Now, your profit in property, I'm not going to go into too much on property now when I talk about shares, etc. Your profit in property is ideally made when you buy the property. So what you want to avoid is paying, obviously, too much for a property. So Conrad will teach you, would have taught you some last night. There's a 2-day seminar. Some of you have done that. That's free. You can attend that property and finance seminar, and they'll go through a checklist and criteria. So if you really want to get into property, you can study that more. Come away with a checklist, what to look for in real estate. Go out there and buy your real estate. Okay? Now, even if something went wrong in real estate, let's think about this. The Gold Coast is famous for two-tiered marketing. Is that true? Those who understands what two-tiered marketing is? No one? No one understands what two-tiered marketing is. It's been a while since they used to do it. Some of you do, okay? My God. You don't know what... Okay, I better explain this to you. If you don't know what two-tiered marketing is, you're likely to get ripped off. Now, it doesn't happen so much anymore, but this is what used to happen, particularly on the Gold Coast, is that marketeering companies would get hold of some real estate, and let's say it was a $150,000 apartment or unit on the Gold Coast. Let's say it's $150,000. They wouldn't be happy with the 2% or 3% real estate commission. They would get that, and they would resell it, say, to interstate holiday makers who are up here on a holiday through high-pressure seminar sales or just high-pressure sales. They'd give you a free flight to the Gold Coast, and they would sell that to you for $200,000, and they would pocket the $50,000 profit. Therefore, they could afford to give away a few free airline tickets. Is that true? And that's what they did. So people were flown, telemarketed. Someone would have visited them at their house or something from a seminar, and they would have been flown free tickets up to inspect some properties, and they would have been shown how property is a great investment, long-term, blah, 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 which is true. That part of it's true. But they neglect that the fact is they've got a $50,000 or whatever margin in here, and this $200,000 property, if you had to walk down the street and checked out other real estate agents, similar property you could went in and bought for $150,000. So people end up paying, and the banks were in on the deal. The banks knew it wasn't really worth that, but the banks didn't care because they couldn't lose, so they would loan money against that as well. And often these two-tiered marketing companies would have their own finance broker, their own in-house lawyers, or all working together. So you always want to keep some independence in that. So the average person who's not switched on ended up paying too much for property. Making sense? But here's the interesting thing. Some people are too fearful to invest in property back in the 80s and 90s when a lot of this was going on and missed the boat. Even the ones that got scammed. This is how forgiving properties. Even the people that got scammed and paid $200,000 for these properties, if they stayed in the property long enough, guess what happened? Went up in value, and some of these properties today would be worth $450,000. Even they totally stuffed up and got ripped off, they would have still been better off over time than someone that didn't do anything. Who's following what I'm saying here? Okay? So in some cases, they were still rewarded because they actually took action. All I'm suggesting is what you do. Your profit is made the past. So all they did was gave an extra 50 grand profit away to the property marketeering company when they could have saved themselves that and bought the property here. Okay? And that would have made them a lot more money. So that's probably the worst thing that can go wrong in real estate, is paying too much for it. Okay? So I would never buy a property without a valuation. Very rarely have I ever bought it without an independent valuation. Okay, not someone's appraisal, or not some. What they used to use is colleagues that were valuers that would just mark up the value. These days, independent valuations are fairly conservative. If you can buy a property under independent valuation, or even at independent valuation, that's generally a very good deal. Because generally valuers will be conservative and generally will value slightly below the real market value. True? Those you know about property, generally that's what will happen if they're independent. So that's what you want to do in property, is obviously buy well, sit and wait. Of course, there's tax benefits of investing in property. Conrad will teach you more of that if you want to go and learn more about that with property. So that's what I did. I started buying property. I also learned how to buy some property no money down. I still buy at times property no money down. I love that. There's many different ways to do that. I teach some of that on the home study. You'll learn some more of that over the weekend. So that worked well. So I buy property predominantly to buy and hold for capital growth. I think property is great for capital growth. In the beginning, it's not so great for cash flow. I was anti-shares, so the only other place you can invest is the share market. True? So I was anti-shares because I'm thinking, well, property's working for me. I bought properties, they're going up in value. This is great. My mentor said it should take 10 years to double, sometimes longer. And I'd bought some property because I got in before the last boom. Some property that doubled in 2, 3, 4 years. I'm thinking, my mentor was a little bit slow. It's actually happening quicker than he said. Okay, but didn't realise that sometimes that 3 or 4 year cycle might be quick and then it slows down, but it averages that. So some people say, oh, property doesn't always double in 10 years. I'm saying, well, my idea is this. Is a 10-year plan better than no plan? I'd say yes. Is a 10-year plan better than the pension plan? Well, if it takes 15 years to double, it's still doubling in value. Okay, it's still an asset that's appreciating. Where most people are too scared to invest in property, are going too scared to do that, but they'll go and buy a second car. And we know in 10 years' time what a second car's worth. When I teach the youth, like I'll teach them on Monday at Youth Summit, a classic example is this. When I was about 15, 16, when I was making more money than my school teachers, the way I was doing that is that I was into drugs. No, I'm just kidding. I had a Swede turnip business. Who knows what Swede turnips are? Anyone? They're what people put in soups and things like that. So on the farm, we would grow them because if there was a market for them, we would sell them to the Brisbane markets. If there wasn't a market for them, the cows ate them during winter. So it was a lot of work to grow a crop, and then in the middle of winter, you've got to harvest this crop with your bare hands, and late at night, it's freezing cold. And so it was a lot of hard work. But when there was a good season and everything lined up, I made a lot of money. So I had nearly $17,000 in cash saved up when I was about 15 or 16. And my goal was to be a millionaire at 18. And I had the opportunity to buy a farm, neighbouring farm at the time, 3,000 acres. It was a lease farm, Crown lease. It was only $17,000. So I had almost enough money to pay cash for that farm. But instead of buying cash for that farm, which really I should have done, it would have been a great investment, I was talked into it by one of my older brothers to put the money into a fast car. Because a car equals freedom, and when you're a teenager, you have a hot car, you're going to have lots of girlfriends. Okay? So I ended up doing that, okay, into a hot car, and I spent all that money, and he ended up crashing it and wrecking it. Now, today that car is, what do you think it's worth? Zero. Okay, it's worth nothing. It's a depreciating asset. Okay? Yet, if I had bought that property, what do you think that property's worth today? It's worth about probably $750,000. And I know that because I bought it many years later. Okay? I paid $346,000 for this property many years later. Okay? So that's a good example. Like even if you're a teenager, you go, do you want the fast car or do you want the wealth over time? And then you can afford to, you could sell a $750,000 farm and buy 2 Ferraris fully paid off. Or you could borrow against that and use that as equity and fund a Ferrari. So it's a different way you look at it over time. So a lot of people have stories. I know in Noosa, one of my uncles